Now let's come to inheritance tax. Now in your exam, how is inheritance tax going to get tested? For sure, you know that one case question is coming from inheritance tax. And to be very honest, easy marks can be scored from these areas, inheritance tax. Now let me put your focus into what are some important areas, like what are some key classifications or some important topics in inheritance tax. Some frequently tested areas. Okay. One is the IHT calculation on PET or CLT. Now they can ask you either for lifetime tax or death tax. I hope you know the difference between both of them. If not, we'll consider it in a while. Okay, the difference between death tax and lifetime tax. So lifetime tax is there as well as death tax. So should be careful what they ask you in the question. Then the exemptions in IHT, that's also very frequently tested topic. Then the concept of nil rate ban and residence nil rate ban, especially with regards to transfer of spouse, unused nil rate ban, that's also something gets tested very frequently. Then the calculation of the death estate, they ask you either for the chargeable estate or for the gross chargeable estate. And also they can ask you for the tax calculation, the IHT arising upon the death estate, then the 7-year accumulation period, then also the payment dates are also important. All right, now let's focus on this. Now IHT usually arises in two situations. One is for lifetime transfers. Yes, for lifetime transfers, that is lifetime transfers. As you already know, lifetime transfers means what? What is lifetime transfers? As in your PET and CLT. It arises in that situation, lifetime transfers. That is PET and CLT. Yes, PET and CLT. And the death estate. IHT also arises upon the death estate. In these two situations is mainly when IHT arises. And for IHT to arise, there must be a transfer of value and there must be a gratuitous intent with a diminution in value. Gratuitous intent means it must be with an intent of not making profits, but anyways, we're gonna incur a loss, okay, with a diminution in value, okay. Now, diminution in value is one area where questions usually come up. Question usually comes up from those areas. We'll be considering that in a while. Now, type of lifetime transfers and their meaning. Lifetime transfers are of two types. One is PET, the other one is CLT. PET is potentially exempt transfers, which means the transfers that an individual does to a person does to an individual. Is there lifetime IHT on PET? No. Lifetime IHT, no. And what about death IHT? What about death IHT? What about death IHT? If death happens within 7 years of the transfer, there will be a death IHT. So if death happens within 7 years of transfer, happens within 7 years of transfer. Now, what about CLT? What is a lifetime IHT? Lifetime IHT, by the way, death IHT percentage is 40%. Now, lifetime IHT on CLT is 20%, and death IHT is same as above, same for PET. If death happens within 7 years, we can say that there will be a death IHT, and it is 40%. Okay, that is with regards to lifetime transfers. Now, this is one tested topic. There is diminution value with respect to shares. When you transfer shares, they will ask you what is a transfer of value, what is diminution in value. How do you find the answer? Value before transfer. Okay, value before transfer minus value after transfer. Value before transfer and value after transfer. Okay, value before transfer and value after transfer. In your revision kit, question, BPP revision kit, 163 and 169 is with regards to this area. So if you're sure, if you know how to do it, you don't have to waste your time there. But if you want to have a look, you can go through it. Diminution in value, it's also a tested topic. Then we need to discuss about exemptions, because again, it is a very frequently tested topic. Now, all these exemptions are with regards to our lifetime transfers. Okay, all of these are with regards to our lifetime transfers, which is CLT and PET. Out of the exemptions you can see here, only one exemption is applicable even during death estate, which is that spouse exemption. Remaining everything else is available only during the lifetime. Let's discuss about these exemptions in a while. Now, small exemptions is like each gift must be pound 250. Like for each person, we can give a gift of pound 250 or less than that will be exempt. Now, it's not like everything above 250 is exempt, is taxable. Not like that. If the gift is 250 or less than that, and it's exempt. If it's above 250, then it's taxable. I mean, you have to pay IHT for that. And exemption, the amount is 3,000 every year. Every tax year you get 3,000. You can use it, like if last year's is not used, you can use it this year. You can carry it forward once. Now, normal expenditure out of income means that certain payments to your certain payments, which is very much normal expenditure out of income. You have some examples in your hand, or so I've given you one examples over there. Such payments are not considered taxable under IHT. Okay, and I'll tell you one more example which you can look at with regards to normal expenditure out of income. So for normal expenditure of income, in your revision kit, the BPP revision kit, there's a question called Zoe and Luke, and you can see in the information with regards to Luke, you can see it's written like, about normal expenditure about income. Luke had also paid his son's university tuition fees in each of September 2018. Like that's some information. That is an example of normal expenditure out of income. And also there's the marriage exemption. Then there's a spouse exemption. Spouse exemption is like whatever amount you actually transfer to your spouse is actually fully exempt under IHT. Now, this can be with regards to any lifetime transfers as well as anything as part of your death estate. Now, when it comes to marriage exemption, it's like in the UK, when you give, so when a parent, so it's like in the occasion of a wedding, so marriage exemption and annual exemption, first priority is always for marriage exemption. So let's say there is a marriage. So in that case, any payments by parent up to pound 5,000 is exempt. Okay, pound 5,000 is exempt, and 2,500 if it is by any one of the party of the marriage, like any one of the party of the marriage, or by any other ancestor like grandparents or anything like that, and 1,000 by any other person. So 1,000 by any other person. So that is marriage exemption. Always remember to use all of these exemptions before your annual exemption. All right. Okay, now let's discuss some other important points. Now, if you take a look at this, now the other points which are on top we've discussed is I'm already discussing what we haven't. If donor pays a lifetime tax on CLT, then the rate becomes 25% instead of 20%. Okay, it becomes 25 instead of 20. And remember, when it comes to calculating gross CLT, what is the meaning of gross CLT? Gross CLT is how much of your wealth have you had actually lost because of the transaction, to keep it as simple as that. So when Donnie is the one who is paying the tax, you find gross CLT by reducing the AE from the CLT. But if donor is the one who is paying the tax, okay, if donor is the one who is paying the tax, in that case, gross CLT is the the amount, the net amount, or the amount after your, after reducing AE, that particular amount plus your tax paid plus the IHT paid. Yeah, plus the IHT paid in lifetime IHT paid. This is the gross CLT. Always remember that. Okay, because gross CLT is what we use for the death IHT calculation and all that. Now the nil rate amount for nil rate band for the tax year 2020-21 is 325,000. No change to that. There is no change in that. Now with regards to 7-year accumulation period, what exactly is 7-year accumulation period? Now it is true that each year you get a nil rate band of 325,000. That's true. You get a nil rate band of pound 325,000. But the tax authorities always make sure that in a period of 7 years, you're not using more than 325,000 in total. In that case, what you would do is every year you would just keep transferring your wealth little by little, and you would save a lot of tax. That is why. So 7-year accumulation period is like this. When you're calculating lifetime IHT, you know very well that IHT is calculated during lifetime and during death. So lifetime IHT is like you do the CLT, you write the CLT amount, the PET amount, and all that. And after, when you calculate IHT, you write the 325,000. Okay, the 325,000. When you write, you have to be careful to apply the 7-year accumulation period. Now, lifetime IHT calculation. Take a look that 7 years back from the gift, were there any gross CLTs? So check if there are any gross CLTs. Check if there are any gross CLTs. Okay. And what about death IHT? In the case of death IHT, you have to check two things. Check if there are any gross CLTs or chargeable PETs. Okay. Chargeable PETs in previous 7 years. Okay. So gross CLTs in previous 7 years, chargeable PTs in previous 7 years. It's like when you're calculating your death IHT and you've written the gross CLT and all that, and you come into the IHT calculation. When you write 325,000, take a look. In between the time when the gift was made, just compare. The gift was made just 7 years back before the gift. Any gross CLTs, any chargeable PTs. Chargeable PTs means PTs that become chargeable upon death. Not all PTs are chargeable. So any chargeable PTs or gross CLT. So if you want a proper idea of how 7-year accumulation period works, there is one question which I have done. I have uploaded in the drive, IHT part 1, part 2, part 3. Okay. Now that is with regards to 7-year accumulation period. Then there is something called the taper relief. Taper relief is applicable for all the calculations that you do during the death time. What is taper relief? Taper relief is like if the time between your death and the time you made the gift and the death, if it is 3 years till 6 years, you can actually claim some relief. That is taper relief. In the tax tables, the percentage is given. Now I'll just show you a small idea of in questions when the questions ask you calculate IHT. What do you do? Now the question says calculate IHT. First thing to look at is the question asking for lifetime IHT or death IHT. So lifetime IHT, if it is with regards to lifetime IHT, then what are you supposed to do? Write the amount of the CLT or the PET and reduce the AE. And if it is a PET, there is no tax. If it is a CLT, calculate 20 or 25%. If they ask you lifetime IHT, that's simple. But if they're asking you for the IHT arising upon death, okay, what do you do? Now, let's say it's a CLT, for example. First, you write the gross amount of the CLT, okay, the gross amount of the CLT. Then when it comes to the IHT calculation, 325,000 into, like you have to do the 7-year accumulation period calculation. Okay, the 7-year accumulation period calculation. You write 325,000 to 0, or you apply the 7-year accumulation period. Okay, you have to apply the 7-year accumulation period here. Then the remaining amount into 40. Okay, you will get one answer here. Now, what all should you reduce then? The taper relief. If it is applicable, reduce the taper relief. And also IHT already paid. Okay, IHT already paid. That's a lifetime. If you already paid any IHT for that, you have to reduce that. Okay, and then you will get the answer. Calculate IHT, that is the answer. The answer you get there, that is what your answer is. So be very careful. If they ask you for lifetime IHT, that's how you do. If they ask you for death IHT, it's better you start from lifetime IHT onwards, because then the amount you have is after your AE and all of that. All right. Now coming to death estate. Okay, now coming to death estate, that is also a very frequently tested topic. Death estate format, you don't have to mug it up or anything like that. It's like all your assets together and you reduce your liabilities. You get your chargeable estate. Okay, you get your, I think it's time you look at your IHT format. You get chargeable estate. So remember, chargeable estate, and from chargeable estate, when you reduce your spouse exemption, that is when you get your gross chargeable estate. Gross chargeable estate. Okay, that is when you get your gross chargeable estate. Okay, so gross chargeable estate is different from chargeable estate. Be very careful what they're asking in the question. And also your death estate format, keep note of mortgage interest repayment in case you can go and check in your format what is it that we can reduce. And in the case of insurance, if they give you market value and the proceeds amount, what is it that you use? Now with regards to residence nil rate band, okay, there is a residence nil rate band you get of 175,000, okay, in 2020-21, all right, in 2020-21. Okay, so it's like this is only applicable for death estate calculations. You get an additional 175,000 of nil rate band, and for this there are again conditions. There are 3 conditions which you see there. So 175,000 is the amount, and your death estate, in the death estate, the main residence, it must have been transferred to any direct descendants, and the death must have happened on or after 6th April 2017, and obviously they must be residential property inside the death estate. These are the conditions for getting an RNRB. So RNRB is a very important area. And also something else is with regards to the transfer of unused nil rate band. Okay, transfer of unused unused nil rate band. Now usually, usually it's like one person has a nil rate band, the person dies, the second spouse also dies. When the second spouse dies, the second spouse gets to use that spouse nil rate band plus the nil rate band of the previous spouse who died. Like, if there's any unused nil rate band, they get to use that in the newer rates. Like if the old when the other spouse died, the nil rate band was 312,000 and he or she used only 40%. Then when this spouse actually takes the unused nil rate band, it's not going to be 60% of 312, but 60% of 325 unused nil rate band. And when it comes to unused residence nil rate band, remember, if one spouse gets residence nil rate band, then definitely the previous spouse, the spouse who died before that, will also get the unused nil rate band of that spouse as well. It does not matter when the other spouse died and whether in that house, in that estate, there was a main residence or not. That's a very important point with regards to residence nil rate band. And something else also which you really need to know is about the payment. Who pays the IHT and when do they pay it? So you can take a look at who pays it here. Person liable to pay and when they pay. Payment date is also quite important. Now, usually for all IHT questions, one question is with regards to who pays it. So go through this. It's quite important. Yeah, it's only in the case of PT. I mean, in this case, it is different. Remaining everything else is like 6 months. It's the same thing. All right. Now, this is one theory area that could get tested. Like, how do you plan your IHT? Like, how do you ensure that IHT is, reduced? Use exemptions, make gifts early, make use of nil rate bands, skip a generation. So to get more information on this, read BPP page number 286 to 87. We have a BPP workbook. It will also be there under the heading Basic Inheritance Tax Planning. So hope you go through this as well. So IHT is actually quite a very easy area to handle. Your case question, you can score maximum out of that if you go through all these areas properly.